The wrong JV partner will cost you more than any bad deal ever could. Everyone talks about finding private money and partnering up to scale, and no one talks about what actually happens when you end up in a 6-unit investment with the wrong person and you basically are married to someone who you wouldn't even go on a second date with. So let's fix that. We are talking specifically about finding a JV partner for a 6 to 20 unit asset, not some giant 20-unit syndication or a cute Airbnb split. A real small multifamily JV where your partner choice can make or break not just the deal, but your sanity. We are going to walk through 3 big things: how to find the right partner, what to watch out for, and how to structure it so you're actually protected if things go sideways. First, let's talk about why you would want a JV partner in the first place. Most people come into this with 1 or 2 gaps. Either I can find and I can operate a deal, but I'm short on capital, or I've got the capital and the W-2, but I do not know how to find or underwrite or manage this thing. A good JV is usually a trade between those two: money and stability on one side, and time and operational skill on the other. But here's the mistake. People go hunting for money before they're crystal clear on what they are bringing to this equation. So step 1, before you set out to find a partners, be brutally honest about what you yourself bring to this table. If you're the operator, that means that you're the one that's going to go out and do the hunting, the underwriting, the due diligence, bank relationships, management, asset plan. You're not helping with the deal, you are the deal. And if you're the capital partner, that means you're not just wiring money and disappearing, you're taking the risk. Your credit might be on the line, your expectations and timelines have to be crystal clear. And if you can't articulate your value in just a couple of clean sentences, you are not ready for JV. You're just hoping that someone will rescue you. Now, where do you actually find partners for this 6 to 20 unit place? Here is a brutally honest, unsexy answer. You don't find them on Instagram DMs. You find them where serious, slightly boring, financially stable people hang out. That could be your local real estate meetings, chamber of commerce meetings, could be meetups specifically for multifamily, or it could be just small business owners, doctors, tech professionals in your city who are just sick of having 100% of their net worth living in the stock market. Your pitch is not, do you want to invest in my deal? Your pitch is, I specialize in small multifamily between 6 and 20 units in, let's say, South Carolina. I find, underwrite, and operate the deals, and I'm looking for 1 or 2 serious partners who want to co-own these assets. Is that something you'd want to talk about? You are not bagging, you are not selling a course, you are positioning yourself as the operating arm of a very specific niche. And then you watch how they respond, which leads us straight into the big one. What to watch out for. All the biggest red flag in a JV is not they don't have enough money. It's misalignment. Misalignment in timeline, misalignment in risk tolerance, misalignment in how they behave when something goes wrong. You need to know, are they thinking like a trader or like an operator? If you're planning to hold for 7 to 10 years, you plan to operate, refinance, grow equity, while they're expecting a quick flip in 18 months, that's not going to be a partnership. That's a pending war. So pay close attention to how they talk about losses. Do they blame everything else? Or can they explain what they've learned? If every bad thing in their life is someone else's fault, this will be you the second the market turns. And then there is character. I'm not talking about just nice. I'm talking about consistent. Do they show up on time? Do they respond when they say they will? Do they follow through on small things? If someone can send a document on time, you do not want them signing along with you. And lastly, watch how they talk to service people. I know it's uncommon, but the waiter, the assistant, the property manager, that's how they will talk to your tenants and vendors. And if you have to spend 3 years cleaning up their relationship mess, your passive income becomes trauma bonding with your lender. And also pay attention to their personal financial chaos. If they're constantly juggling cards, hoping for one big thing to the next, and every story ends with, I was this close to making millions, that is not a partner. That's a walking capital call. You want someone whose life has at least a baseline of order, stable income, bills paid, not changing business ideas every 2 weeks. Boring in this case is good, and boring pays distributions. Okay, so let's say you've found someone who seems aligned, who is stable, not a walking red flag. Now we get to the part that everybody skips because it feels too formal. Structure. If you take nothing from this, take this sentence. If it's not in writing, you don't have a partnership. You just have vibes. For a 60-20 uni JV, you're almost always forming an LLC that owns a property. You and the partner will own the LLC. That's the container. Inside that, you need two things. You need an economic structure and a control structure. The economic structure determines who puts in what, who owns what, and how does the money flow when things work. The control structure is who decides what happens when things don't work. On economics, keep it simple but clear. If you're an operator, you're typically not just getting the same as your money partner. You're bringing sweat equity, expertise, and risk. That can look like a split where the capital partner brings, let's say, 70 to 80% of the equity and then gets a preferred return on their money, and you get a smaller equity distribution, but a larger share of the upsides for doing the work. So, for example, they bring most of the cash, let's say 6 to 8% preferred return on their investment if the property supports it. And then after that, after they get paid and receive their preferred return, profits are split either 50-50, 60-40, 70-30, etc. All depending on what you negotiate. The numbers aren't negotiable. The principle is that capital is respected and operations are rewarded. Now, the control side. This is where the protection lives. You never want to be a JV where nobody knows who's actually steering the ship. If you're the operator, you should be in control of day-to-day decisions, hiring, firing any property managers, approving tenants with agreed criteria, managing renovations within a set budget, handling leases, communicating with lenders, etc. That should be all spelled out right at the beginning. Your partner should not be texting your property manager or changing renovation scopes or promising tenants things that are outside the plan. That's going to create chaos. And then there are major decisions: refinancing, selling the property, taking on new debt, approving big capital expenses above a certain threshold, bringing in new partners, etc. Those should require a joint approval. This is usually written as major decisions that need both members' consent. And you also need to bake in what happens when you disagree and get stuck. That's called a deadlock. So you need to decide, are you going to bring in a third-party mediator? Do you have a buy-sell clause where one partner can offer to buy out the other at a specific valuation? Do you have a shotgun clause where if one partner wants out, they name a price and the other can choose to buy or sell at that price? These are really not fun conversations to have, which is exactly why you have them before you close, when everybody is still polite and nobody is angry. You also want clarity around capital calls. If a roof blows off or a boiler does and property reserves can cover the cost, then what happens? Do you both commit to putting in additional capital? Or what if one of you refuses or can't? Are they diluted? Do they lose some rights? Can the other partner loan money to the LLC with a priority payback? If you don't put this in writing, I promise you will meet the ugliest version of your partner the very first time a big expense shows up. Better to meet that version on paper than in crisis. And a quick word about protecting yourself personally. Please don't be the person who casually signs as a guarantor in a loan with someone they barely know, with no agreement about what happens if that person disappears. If there is a personal guarantee, understand exactly whose name is on it and where the expectations are. If you're the operator and you're guaranteeing the loan, that should be reflected in your economics and control. And if both of you are guaranteeing, say that and define exactly what happens if one person wrecks their credit and blows up the refi. Also, control of the money. Bank account access should not be free for all. And ideally, the LLC has one primary operating account, 2 signatures for large transfers, clear rules around distributions versus reserves. You never want to log in one day and discover that your partner decided to borrow from the company. Let's land this with what you actually do next, because otherwise it's just theory. And if you're serious about JVing on a 6-20 unit, your first move is not to ask who has money, it's to define your role and your lane. Are you the operator? Great. Get 3 sample deals underwritten, build a 1-page summary of the kind of assets that you target and your plan. This is what you show potential partners. And if you're the capital partner, fantastic. Decide how much you're actually comfortable putting into a deal and how long you're comfortable staying in it, and what kind of reporting you need to see to be able to sleep at night. Then you go and look for operator with an actual system, not just good hair and confidence. When you meet someone you might JV with, don't just jump into let's buy something together. Start small, underwrite a deal together, walk a property together, watch how they think, how they talk, how they handle problems, and before you close anything, you sit down and you have an uncomfortable conversation. What happens if we fight? What happens if one of us can't fund? What happens if we need to sell at a loss? What happens if someone wants out in a year 3 versus year 10? If they refuse to have that conversation, that is your answer. And you just saved yourself years of headache. So the right JV partner on a 6-20 unit can shortcut your growth by years, but the wrong one can trap you in real life horror story with a mortgage attached. So be very selective, be boring, be clever, because you're not just picking capital, you're picking who you want on the other side of the table when markets turn, when things go wrong, tenant trashes the unit, or the roof caves in. That is the real JV interview. And if you think this is for you, fantastic. I cannot wait for you to go in the comment section, drop a comment below, and share your JV story. And if you think that you'd rather just try to be a capital connector instead and gain experience that way, I have a video just for you that walks you through all the steps that you need. Don't skip this. We'll see you there.